What if the most valuable thing you own isn't yours at all? What if your money obeys laws you never voted for? What if your freedom was negotiated in rooms you'll never see? Your salary arrives, your card swipes, your savings sit in an account you trust. But in the shadows, rules are written that make your dollars live or die. Who writes those rules? Who decides when money becomes cheap and when it becomes scarce? Who profits first when new money is made? There's a syndicate, not a gang with masks, not a cartoon villain in a smoky room, but a network so powerful and coordinated that it might as well be one. And here's the twist. You already live inside it? Your rent, your groceries, your investments, your debts, all tethered to a machine that hums in the background, shaping your choices. To understand the machine, we start long before your bank app, back when money was metal and trust was heavy. Goldsmiths kept other people's coins in vaults. They issued receipts to claim them. Those receipts became tradable. The receipts became money. And the goldsmiths learned a secret that would change the world. If not everyone redeems at once, you can issue more receipts than gold you hold. You can lend. You can create money out of promises. Credit is born. And with it, a quiet revolution. Kingdoms needed war chests. Merchants needed capital. So public power and private lenders made a deal. Europe experimented with early central banks. Sweden's Riksbank in 1668. The Bank of England in 1694. A bank with a royal charter that funded the state and got the right to create money. Cause and effect follows like clockwork. When states need funds, banks expand credit. When credit expands, economies surge. When surges overheat, crises erupt. And every crisis invites bigger institutions and tighter coordination. Across the Atlantic, the United States flirted with national banks, then rejected them. The first Bank of the United States in 1791, gone by 1811. The second bank in 1816, killed in the 1830s by Andrew Jackson's veto. Then a century of patchwork banking and recurring panics. Finally, the Panic of 1907 hit like a lightning bolt. Markets crashed, banks failed. J.P. Morgan gathered financiers in his library and forced a rescue. America learned a lesson. This ad hoc method isn't enough, so powerful bankers and politicians met off the coast of Georgia. A private island, a secret meeting in 1910, drafts were written, language polished, alliances sealed. By 1913, Congress passed the Federal Reserve Act, a new central bank, a federated structure owned by member banks, publicly mandated, privately linked, independent but not isolated. The world soon lurched from boom to bust. The 1920s roared on easy credit. Then the Great Depression smashed asset prices and trust. Bank runs spread. Gold fled vaults. In 1933, the U.S. broke with tradition. Gold was recalled from citizens. The state seized control of gold flows. In 1934, the dollar was devalued against gold. A new equilibrium was enforced. To coordinate across borders, another player emerged. The Bank for International Settlements in 1930. A club for central banks, officially created to manage reparations, quietly becoming the central bank of central banks. It still sits in Basel, a quiet hub of global coordination. World War II reset the game again. By 1944, leaders met in Bretton Woods. They built a new order around the dollar, the International Monetary Fund, the World Bank. The dollar fixed to gold at $35 an ounce. Other currencies fixed to the dollar. America's economy and gold hoard made it possible. But even then, the seeds of strain were planted. Here's the problem economists warned about. Robert Triffin saw it clearly. For the world to use dollars, America must supply dollars. But supplying dollars means running deficits, and deficits hollow out confidence in the dollar's gold promise. One system, two opposing needs, a contradiction grinding beneath the surface. Meanwhile, a shadow money system was forming overseas. By the late 1950s, dollars held outside America grew in London. These eurodollars weren't under U.S. rules. Banks could create dollar credit without touching U.S. soil. Liquidity multiplied offshore. This quiet pool would later decide the fate of governments. In the 1960s, pressure built. Central banks demanded gold for dollars. America bled gold. Markets doubted the $35 peg. In 1968, a two-tier gold market tried to buy time. By 1971, time ran out. President Nixon closed the gold window. The dollar was no longer redeemable for gold. Paper credit ruled alone. The old anchor was cut. OPEC's oil shock followed. But another deal replaced the old anchor. Oil was priced in dollars. Oil producers recycled their dollar surpluses through Western banks. The petrodollar was born. The flow of energy and the flow of credit fused. Banks feasted on recycling. Sovereigns borrowed. Global finance swelled. Then came the Volcker shock. Inflation raged. The Federal Reserve hiked interest rates into the stratosphere, above 15%. Some loans broke. But the dollar's credibility was rebuilt through pain. Developing countries buckled. A Latin American debt crisis exploded in the 1980s. IMF programs arrived with conditions: austerity, privatization, Open capital markets, the syndicate's reach extended into policy itself. Deregulation followed in waves. New instruments, new derivatives, new leverage. Giant banks sprawled across continents. Investment banks merged with commercial banks. Risk pooled behind computer models and credit ratings. And when risk exploded, rescues returned. In 1998, long-term capital management imploded. A hedge fund tied into the system's core. The Federal Reserve convened a private rescue. A signal flashed. When bets go bad at the center saves the core. In 2008, the dam broke completely. Mortgage credit had stacked a pyramid of promises. Subprime loans disguised as safe. Derivatives multiplied exposure. Lehman collapsed. AIG cratered. Markets froze. The entire network trembled. Governments and central banks unleashed extraordinary measures. TARP, swap lines, zero interest rates, quantitative easing, balance sheets ballooned. The message was unmistakable. We will not let the core fail. But there was a cost. Asset prices soared. Stocks recovered quickly. Bonds rallied. Real estate rose again. But wages lagged. The people who held assets did well. Those who held only cash and labor did not. The money machine had a new mode. When trouble hits, money is created at the top. It flows through markets, not directly to you. By the time it arrives in prices and wages, the first recipients have already bought the assets. Economists have a name for this pattern, the Cantillon effect. Early receivers of new money benefit first. Late receivers pay higher prices later. It is not a theory. It is the logic of timing. Reforms tried to draw lines. Basel III raised capital buffers. Stress tests improved. Living wills were written for big banks. Dodd-Frank added rules, then some were rolled back. Yet the giants got bigger, the system grew more concentrated, and bailouts, once never again, became a playbook. The next act began quietly in 2019. Overnight lending rates in the repo market spiked. The Federal Reserve injected liquidity into the core. Then came 2020, a pandemic and a shutdown. Markets dived, unemployment spiked, and then unprecedented firepower. The central bank bought corporate bonds, the Treasury sent checks, the money machine went into overdrive. By 2021, the shock had mutated. Inflation roared to 4-decade highs. Supply chains groaned. But the deeper cause was visible too. Money had surged, credit had expanded, demand outpaced supply, and prices answered. To fight inflation, rates were hiked at the fastest pace since the 1980s. The cost of borrowing jumped. Bond portfolios fell. In 2023, several banks failed. Silicon Valley Bank, Signature, First Republic. Losses on safe bonds triggered panic. A new facility was created almost overnight, the Bank Term Funding Program, another backstop for the core. What's the syndicate then? It's the living network that sets the rules of money and credit. Central banks, commercial banks, asset managers, clearinghouses, payment networks, ratings agencies, and the international bodies that coordinate across borders. The central banks set the tempo with interest rates and liquidity. Commercial banks create most of the money when they make loans. Yes, most of the money in modern economies is created by private banks issuing credit, not minted by governments, not printed in basements, created with keystrokes, secured by collateral, and multiplied by confidence. International institutions align policies. The IMF sets conditions. The World Bank funds long-term projects. The BIS hosts meetings, studies risks, and promotes standards. Not a conspiracy, a structure. But structures can concentrate power without central plots. And this one does. Asset managers sit atop the capital markets that central banks prop up. The top 10 asset managers oversee roughly $50 trillion. BlackRock, Vanguard, State Street alone manage over $20 trillion combined. Their ownership stakes span thousands of companies. They vote on corporate policies. They help governments design rescue tools. When liquidity is injected, their world moves first. Payments are the bloodstream. Visa and MasterCard process over $20 trillion annually. SWIFT messages tie banks across borders. Chips and Fedwire settle the heavy transfers. Sanctions, blacklists, freezes. These are monetary weapons. Access is permissioned. Permission can be revoked. Freedom depends on pipes you do not control. Here are the numbers that bring the pattern into focus. Daily foreign exchange trading averages about $7.5 trillion. The US dollar is on one side of roughly 88% of all trades. Around 58% of global foreign exchange reserves are held in dollars. The dollar is the operating system of global trade and debt. Central bank balance sheets ballooned after 2008 and 2020. The Federal Reserve's assets peaked near $9 trillion. The European Central Bank and the Bank of Japan also swelled dramatically. Then came attempts to shrink, but each shock stalls the shrinkage. Each crisis demands a new expansion. The ratchet turns one way. Global debt has climbed past $300 trillion as governments, companies, households. Debt serviced by income that grows slower than the obligations. So policy leans toward lower rates. Towards stimulus when things crack, toward rules that prefer debt survival over cleansing resets. Meanwhile, wealth concentration marches on. In the United States, roughly a third of all wealth is held by the top 1%. Asset booms lift those who own assets. Cheap credit rewards scale. The Syndicate safety nets stabilize the core, but they also tilt the playing field. Now, look at the repeating pattern. Crisis leads to coordination. Coordination leads to concentration. Concentration leads to fragility. Fragility invites bigger rescues, and bigger rescues concentrate power again. Attempts to fix the machine stumble on the same constraints. Raise capital too high, and credit tightens sharply. Loosen standards, and risk builds quietly. Ban risky products, and risk migrates offshore. Regulate banks, and leverage appears in shadow banks. Every wall creates a tunnel. Every tunnel finds the same destination, back to the core. Cryptocurrencies tried to exit the system. Some promised hard money. Some promised programmable freedom. But speculation overwhelmed utility. Stablecoins tied themselves back to the dollar. Exchanges mirrored old intermediaries. And when disasters hit, the old pipes still mattered. On-ramps, off-ramps, banking relationships, law and regulation. The net pulls you back. New proposals promise modern solutions. Central bank digital currencies, CBDCs, faster payments, cheaper transfers, programmable features. But programmability cuts both ways. It can empower or control. It can enable inclusion or enable surveillance. And because the core writes the code, the defaults matter. This is not about villains twirling mustaches. It is about incentives and structures. When private credit creates most money, the credit cycle rules daily life. When market stability is the top priority, rescues flow upward first. When international trade runs on a single currency, geopolitics becomes monetary policy. So, who owns your currency? Legally, the state issues legal tender. Operationally, private banks create most of what you use. Strategically, central banks set the climate in which all of it breathes. And the larger network enforces access, speed, and terms. That is the Syndicate, not a secret handshake, a system you can map, a system that still surprises even its architects. And your freedom? It expands when you can choose among credible options. It shrinks when exit is costly, slow, or blocked. If the only safe place for value is inside the pipes of the system, freedom narrows. If alternatives are credible, privacy-protecting, and liquid, freedom grows. Look again at today's headlines and see the pattern. Bank failures, instant rescues, volatile inflation, synchronized rate hikes across continents, asset managers advising governments while buying the assets governments support, payment networks used as policy tools, and over 90% of central banks exploring digital currencies. The future of money is being coded right now. Some data points feel like a jolt. A double-digit share of listed companies are zombies, unable to cover interest from profits, kept alive by cheap credit and rolling debt. The repo market, not your neighborhood bank branch, decides whether short-term money flows. And in many countries, more than 90% of the money supply exists as bank deposits created by lending, not as physical cash. When banks slow lending, money creation slows. When they contract, money disappears. That scarcity is felt in jobs, prices, and growth, cause and effect, again and again. So what can you do in a world like this? You cannot vote for the FOMC. You cannot attend Basel meetings. But you can understand the machine. Understanding changes your choices, and a lot of small choices add up. Diversification is not just a buzzword. It is a defense against a system that alternates between boom and rescue. Liquidity matters. Buffers buy time. Debts that float with the tide expose you to the tide. Debts that lock in the rate buy you certainty. Choose accordingly. Demand transparency from the platforms you use. How are your assets held? Who is your counterparty? What happens in a freeze or a shock? In a world of bail-ins and backstops, the fine print is a life raft. Engage with policy too. Public pressure shapes code. Digital cash can be privacy preserving, or it can be a panopticon. If you want freedom tomorrow, show up today. As we close, hold 3 takeaways tightly. First, most modern money is created as bank credit, not printed by governments. When banks lend, money appears. When loans are repaid or defaulted, money vanishes. Understanding this gives you X-ray vision for cycles. Second, every major crisis has concentrated power in the financial core. Rescues stabilize markets but tilt rewards toward incumbents. Protect yourself by diversifying across assets, custodians, and jurisdictions when possible. Third, the pipes of the system decide who can transact, how fast, and on what terms. Payment networks, clearinghouses, and digital rails are not neutral. Support options that preserve openness, privacy, and competition. A warning as we look ahead. The next storm may mix 3 dangers at once. Fragile banks with long-duration losses, sovereign debts that soar as rates rise, and programmable money that can be steered with code. The line between stability and control is thin. If the wrong defaults are chosen, you could gain speed but lose agency. Or we could choose better. We could build resilient rails that don't require surveillance. We could separate safety nets for people from bailouts for risky bets. We could make sunlight the cost of rescue. That is a choice, not a destiny. If this episode shifted how you see your money, share it. Teach someone the map you just learned. Subscribe for the next deep dive. Drop a comment with what you want decoded next. And remember, the system is powerful, but it is not inevitable. Knowing how it works is the first act of freedom.